Ladies and gentlemen, friends, buckle up because what I'm about to share with you today is not hype. It's reality. We are in the midst of one of the most historic moves in the precious metals markets that no mainstream financial pundit wants to admit. Gold and silver aren't just rising. They're soaring against a weakening dollar and rampant monetary inflation. And if you own even a grain of physical gold or silver, you need to hear this because what's coming next could make today's prices look cheap in hindsight. For years now, people have been told not to worry about the dollar. They've been told that deficits don't matter, that money printing has no consequences, and that somehow this time is different. But markets don't lie. And what we're seeing right now is the dollar quietly but steadily losing its grip. And as that grip weakens, something very predictable is happening. Precious metals are responding exactly the way they always do when confidence in paper money starts to fade. The dollar's problem isn't sudden, and it isn't mysterious. It's the direct result of policies that prioritize short-term political comfort over long-term economic reality. Trillions of dollars created out of thin air, endless deficit spending, and an economy propped up by cheap credit instead of real savings and productivity. You can only debase a currency for so long before the world starts to notice. And the world is noticing now when a currency weakens. It doesn't announce itself with a press release. It shows up in higher prices, shrinking purchasing power, and in the quiet migration of capital into real assets. Gold and silver don't rise because they suddenly became more useful. They rise because paper money is becoming less trustworthy. Precious metals are not going up in value. The dollar is going down in value. That distinction matters because it tells you this move isn't speculative. It's defensive. Investors around the globe are slowly waking up to the fact that holding dollars means accepting guaranteed loss in real terms. Inflation isn't a glitch and it isn't transitory. It's baked into the system once you choose inflation as a policy tool. You don't get to turn it off without consequences. And those consequences are now being reflected in the price of gold and silver. What's especially important is that this isn't being driven by retail hype snorts or social media speculation. Central banks, particularly outside the United States, have been accumulating gold at a pace we haven't seen in decades. They understand what many individual investors still don't. Reserves held in fiat currency are only as strong as the discipline of the government issuing them. And discipline is exactly what's missing. Silver, meanwhile, is doing what it always does in the early stages of a real monetary repricing. It lags, frustrates, and then suddenly accelerates. Historically, silver doesn't just follow gold, it eventually outperforms it. That's because silver sits at the intersection of monetary metal and industrial necessity. It's real money, but it's also essential to modern technology. When confidence in fiat erodes and industrial demand remains strong, silver becomes incredibly difficult to suppress. The mainstream narrative still tells people that the dollar is strong because it's the least bad option. But least bad doesn't mean good, and it certainly doesn't mean safe. A race to the bottom is still a race to the bottom. Just because other currencies are also being debased doesn't protect the dollar from the same fate. In fact, it accelerates the global shift toward neutral, non-political stores of value, and that's where gold and silver come in. What we're seeing now is the early stage of a broader recognition that fiat money is a promise. And that promise is only as credible as a balance sheet behind it. When that balance sheet is drowning in debt, when interest costs alone threaten to overwhelm government revenues, the promise starts to look fragile. Precious metals don't require trust. They don't depend on decisions or political will. They simply exist, and that's why they matter. Some people look at rising gold and silver prices and say they've missed the move. That's exactly the wrong conclusion. The real move doesn't begin when metals start rising. It begins when the public finally understands why they're rising. We are nowhere near that point. Most portfolios are still heavily concentrated in paper assets priced in dollars. Most people still believe inflation will magically resolve itself. That belief won't last forever. As the dollar continues to weaken, not collapse overnight, but erode steadily, the flow into precious metals will continue. Not because of fear, but because of logic. Because when faced with a choice between holding something that can be created in unlimited quantities and something that cannot, rational capital eventually chooses scarcity. Gold and silver are not about getting rich quick. They're about preserving purchasing power in a system designed to destroy it. They're about opting out of a monetary experiment that has gone on far too long and is now reaching its inevitable conclusion. The dollar's weakness is not a signal to panic. It's a signal to prepare. And the response we're seeing in precious metals is not an anomaly. It's a reminder even after the recent move higher. Silver remains one of the most misunderstood and mispriced assets in the global market. People look at the chart, see that silver has gone up, and assume the opportunity is gone. That's a surface level conclusion, and it ignores a far more important comparison. Not silver versus the dollar, but silver versus gold. When you look through that lens, it becomes clear that silver is still deeply undervalued. For most of monetary history, gold and silver functioned as money together. They weren't competitors, they were partners. And the relationship between them was reflected in a relatively stable ratio over long periods of time. It took far fewer ounces of silver to buy 1 ounce of gold than it does today. That relationship didn't change because silver lost its monetary properties. It changed because markets were distorted first by government intervention, then by decades of artificial suppression and paper speculation. The gold to silver ratio is one of the clearest signals we have of relative value in the precious metal space. When that ratio is high, silver is cheap relative to gold. When it's low, silver is expensive. Today, even after silver's rout, the ratio remains historically elevated. That tells you the market is still pricing silver as if it's an inferior monetary metal, when in reality, it shares many of the same characteristics that make gold valuable: scarcity, durability, and independence from any government's promise. What makes silver especially compelling is that it hasn't yet attracted the same level of institutional attention as gold. Central banks buy gold, not silver. So the gold market benefits from official demand that silver doesn't. But that absence cuts both ways. It means silver is far more exposed to free market forces, and when investment demand finally ramps up a serious way, there's no central bank stockpile waiting in the wings to stabilize prices. Silver is also consumed in a way gold isn't. Gold mostly gets stored, silver gets used. It goes into electronics, solar panels, medical equipment, and countless other applications that modern life depends on. Much of that silver is not economically recoverable once it's used, so while people talk about above-ground stockpiles, they ignore the reality that a large portion of silver supply is slowly disappearing into landfills and industrial products. That's a fundamental dynamic that doesn't show up on a price chart until it suddenly does. On the supply side, silver production is far less responsive to price than most people realize. The majority of silver isn't mined on its own. It's produced as a byproduct of mining other metals. That means even if silver prices rise sharply, supply doesn't automatically surge to meet demand. You can't just flip a switch and mine more silver. That structural constraint makes silver uniquely vulnerable to shortages when demand increases. And demand is increasing whether people want to acknowledge it or not. Investment demand tends to arrive late, but when it arrives, it moves fast. Silver's market is much smaller than gold's, which means it doesn't take much new capital to push prices significantly higher. That's why silver historically moves in explosive bursts. It spends long periods being ignored, then suddenly makes up for lost time. The reason silver remains undervalued isn't because the fundamentals aren't there. It's because confidence in paper assets hasn't fully broken yet. As long as people believe central banks can engineer a painless outcome, tame inflation without recession, reduce debt without default, restore purchasing power without discipline, silver will remain overlooked. But that belief is fragile and is already starting to crack. When gold rises, it sends a signal. When silver follows and then starts to outperform, it confirms the message. We are still in the signaling phase. Silver has not yet entered the stage where it reflects widespread recognition of monetary risk. Most investors still view it as volatile, speculative, or industrial first and monetary second. That misunderstanding is precisely why the opportunity still exists. At some point, the gold to silver ratio will move back toward historical norms, not because history demands it, but because market logic does. If gold continues to be revalued higher in response to monetary debasement, silver will not remain this cheap. By comparison, it never does. The move may not be smooth, and it certainly won't be comfortable, but it will be decisive. Silver's undervaluation is not an opinion. It's a reflection of distorted markets and delayed recognition. When that recognition arrives, the adjustment won't ask for permission. It will happen quickly, and those who waited for confirmation will discover that the bargain is gone. Whenever an asset reaches a record high, the immediate reaction from the crowd is almost always the same. It must be too late. People assume that what has already gone up can't possibly go much further, and that buying at new highs is reckless. That way of thinking might make sense in a speculative bubble driven by hype and leverage, but it makes no sense in a monetary revaluation driven by fundamentals. Record highs don't signal the end of a real bull market. They often mark the point where it begins to reveal itself. What matters is not where prices have been, but why they're moving. When prices rise because of excess enthusiasm, the rally collapses as soon as sentiment shifts. But when prices rise because the underlying unit of account is losing value, the move doesn't reverse, it accelerates. That's the dynamic most people fail to understand. Precious metals reaching record highs is not evidence of excess. It's evidence of monetary reality finally being reflected in the price. Gold has spent years consolidating while monetary excess compounded beneath the surface. During that time, debt exploded, balance sheets expanded, and purchasing power eroded. The price didn't immediately reflect those conditions because markets don't move on logic alone. They move on recognition. Now that recognition is starting to take hold. Record highs are simply the market catching up to what has already happened. The biggest mistake investors make is anchoring their decisions to nominal price levels instead of real value. A record high measured in a depreciating currency is not the same thing as a record high measured in purchasing power. When the measuring stick itself is shrinking, everything priced in it will eventually appear more expensive. That doesn't mean assets are overvalued. It means the currency is. History makes this painfully clear. Every major bull market in gold began with skepticism at new highs in the 1970s. Gold didn't stop rising because it hit records. It stopped when monetary discipline was restored and real interest rates turned positive. We are nowhere near that environment today. In fact, we're moving in the opposite direction. Debt levels are higher. Political pressure to inflate is stronger, and the cost of honest monetary policy is far too high for policymakers to accept. The idea that prices must fall simply because they've gone up ignores how long genuine trends last. Real bull markets are not quick spikes. They are slow recognitions followed by fast repricing. What we're seeing now is the transition between those phases. The early adopters are already positioned. The broader public is still skeptical. That's not the end of a rally. That's the fuel for its continuation. Silver tells an even clearer story. When silver starts breaking out to new highs after long periods of suppression, it's rarely the final act. Silver's role as both a monetary and industrial metal means it tends to lag in the early stages and then surge when monetary demand finally overwhelms paper markets. New highs in silver are not a signal of exhaustion. They are a signal that stress is building in the system. People also underestimate how psychologically important record highs are. They force a conversation. They challenge narratives. They make it harder to dismiss something as irrelevant. As long as gold and silver stayed quiet, they could be ignored. Once they start making headlines, people are forced to ask uncomfortable questions about inflation, about debt, about the sustainability of the system itself. That questioning drives the next leg higher. Another critical point is that most portfolios remain dramatically underexposed to precious metals. Even now, after the rally, gold and silver represent a tiny fraction of global financial assets. That imbalance doesn't correct at the margins, it corrects through price. If even a small percentage of capital decides it wants protection from monetary risk, the price impact will be enormous. That relocation has barely begun. The belief that central banks will step in and fix things is what keeps many people on the sidelines. But central banks are trapped by their own policies. They can't raise rates enough to restore currency strength without triggering financial and fiscal crisis. They can't stop inflating without exposing the fragility of the system they built. That trap is precisely why precious metals continue to make new highs. Record highs are uncomfortable because they remove the illusion of control. They force investors to confront the possibility that what they believed was stable is not. That discomfort leads to hesitation, and hesitation leads to missed opportunity. By the time record highs feel safe, they are no longer early. This rally is not being driven by optimism, it's being driven by necessity. As long as currencies are sacrificed to preserve debt, and as long as real yields remain suppressed, the forces pushing precious metals higher will remain intact. Record highs are not the destination, they are the signal that the journey is underway and that many are still standing at the starting line. Volatility makes people nervous, and that's exactly why it creates opportunity. Most investors say they want value, but what they really want is comfort. They want smooth charts, predictable returns, and reassurance that nothing will go wrong. Precious metals don't offer that illusion. They move sharply, they correct suddenly, and they expose the fragility of the financial system in real time. That's why they're misunderstood. And that's why they continue to offer some of the most asymmetric opportunities available. When gold and silver move, they don't drift, they reprice. And repricing is never a gentle process. Volatility is not a flaw in these markets. It's a feature of assets that exist outside the control of central banks. Paper assets appear calm because they are constantly managed, supported, and backstopped. Precious metals are not. They reflect real supply and demand, real fear, and real confidence, or the lack of it. Short-term volatility often shakes out the very people who would benefit the most from long-term ownership. A sharp pullback convinces them the thesis was wrong. Even though nothing fundamental has changed, in reality, those corrections are usually caused by paper trading, leverage, speculation, or temporary shifts in sentiment, not by improvements in fiscal discipline or monetary restraint. The reasons people buy precious metals don't disappear just because prices move against them for a few weeks. The mistake many investors make is treating gold and silver like stocks. Stocks are claims on future earnings dependent on growth, margins, and stable currencies. Precious metals are not claims on anything. They are money. They don't promise returns. They preserve purchasing power. When viewed through that lens, volatility becomes far less threatening. A fluctuating price doesn't mean the metal is failing. It means the currency it's priced in is being questioned. Silver in particular magnifies this dynamic. Its smaller market size makes it more sensitive to changes in demand, which translates into bigger moves in both directions. That scares people away, but it also creates opportunity. Historically, silver's biggest gains have occurred after periods of extreme volatility when sentiment was poor and conviction was scarce. Those who could look past the noise were rewarded not because they timed the market perfectly, but because they understood the imbalance. Volatility also exposes the difference between traders and owners. Traders react to price. Owners focus on value. Traders are shaken out by headlines and technical signals. Owners look at debt levels, interest rates, and the long-term trajectory of fiat currency. As long as those fundamentals remain intact, volatility is simply the market's way of redistributing metal from weak hands to strong ones. Another overlooked aspect of volatility is it discourages overinvestment. Unlike bubbles fueled by leverage and euphoria, precious metals markets remain relatively small because their price action repels the complacent. That's healthy. It means the market isn't crowded. It means the upside isn't already priced in. Big opportunities don't exist where everyone is comfortable. They exist where uncertainty keeps people away. The current environment practically guarantees volatility. Governments are trapped between inflation and insolvency. Central banks are forced to choose between defending currencies and propping up debt markets. There is no stable equilibrium. In that situation, policy reversals, conflicting signals, and sudden market reactions are inevitable. In that context, expecting smooth price appreciation in any honest asset is unrealistic. Volatility also reveals how distorted the paper markets have become. Sudden drops often occur without any corresponding change in physical demand. Premiums rise, inventories tighten, and yet prices fall, a contradiction that only exists because paper claims vastly outnumber real metal. That disconnect doesn't last forever. When confidence in paper claims breaks, volatility doesn't disappear, it explodes upward. The opportunity lies in understanding that volatility is temporary, but monetary debasement is permanent. A currency that is designed to lose value will continue to do so regardless of short-term price swings and alternative stores of value. Gold and silver don't need perfect conditions to perform. They only need continued mismanagement, and there is no shortage of that. Those who wait for calm before acting usually act too late. By the time volatility subsides, prices have already adjusted to reflect new realities. The uncomfortable periods are where positioning